What is market cap in crypto? The market cap of a cryptocurrency is the total current value of all its coins or tokens in circulation. To calculate a coin's market cap, multiply the price of a single token by its circulating supply. Key takeaways. The market capitalization of a crypto asset is the total market value of all tokens in circulation. It is calculated by multiplying the current market price of a single token by its circulating supply. Market cap provides a snapshot of a crypto asset's valuation and perceived market size, offering insights when used alongside other metrics like fully diluted valuation (FDV) and trading volume. Cryptocurrencies are often categorized by their market cap: large cap, mid cap, small cap, each with different risk-reward profiles. Market cap tells you the total value of a cryptocurrency. You can think of it like knowing the total worth of all the apples from a particular farm. Market capitalization, often called market cap, is a key metric in both traditional finance, like stocks, and cryptocurrencies. In traditional markets, it serves as an indicator of a publicly traded company's value, calculated based on its shares and current share price. Similarly, in the crypto space, it is calculated by the number of tokens in active circulation and current token price. In this article, we'll explore what market cap means for cryptocurrencies. We'll look at how to calculate it, why it matters, its downsides, and how it stacks up against other ways to measure value. Understanding the importance of market cap in crypto in the realm of cryptocurrency. The market cap of an asset represents its total market valuation at a specific point in time. Essentially, it is the total value of all the coins or tokens of that particular asset that are actively circulating in the market and available to the public. While it's typically expressed in US dollars, it can also be denominated in any chosen fiat currency. Market cap offers a general view of the market's current sentiment and valuation of a crypto asset. Cryptocurrencies with a high market cap are usually seen by the crypto community as more established and valuable. Token supply, circulating, total, and max. To accurately calculate and interpret market cap, it's essential to understand the different types of token supply, circulating supply. This is the number of coins or tokens that are publicly available and actively trading in the market. This figure is used directly in the market cap calculation. Total supply. This is all the coins or tokens that have been created. It includes coins that are actively trading and also those that are locked away and can't be bought or sold yet. Max supply. This is the absolute maximum number of coins or tokens that will ever be created for that particular cryptocurrency. Some cryptocurrencies, like Bitcoin 21 million BTC, have a finite max supply, while others may be inflationary with no predetermined maximum supply. How to calculate market cap? Calculate the market cap of any cryptocurrency with this straightforward formula. Market cap equals circulating supply times current price per token. Market cap is a dynamic metric and fluctuates in response to changes in either of the two variables used in its calculation, the circulating supply and the token's current market price. For example, if the circulating supply of a token remains constant, its market cap will increase if the price per token rises, and decrease if the price falls. Furthermore, a project's market cap can also change due to shifts in its circulating supply. This can occur through token unlocks, scheduled releases of previously locked tokens, for example, from team allocations, or investor vesting periods, increase the circulating supply. Mining, staking rewards, new tokens created and distributed as rewards to miners or stakers also add to the circulating supply. Token burns, some projects intentionally burn or permanently remove tokens from the total supply, which can decrease the circulating supply and slow inflation and potentially impact price and market cap. Why is market cap important? The market cap of a cryptocurrency is more than just a measure of its current market size. It's a valuable metric for investors for several reasons. Like company shares, crypto tokens are tied to a specific project. Their value can change based on how well the project is doing and what's happening in the larger market. At a glance, market cap indicates a project's financial standing and provides an overview of how the market currently values it. When investors look at market cap, along with other information about a project, like its technology and team, it can shape how investors perceive the potential of a crypto project. Risk estimation. Assets with a high market cap are often perceived as being less volatile than those with smaller market caps. This is partly because they have typically cultivated a substantial and supportive investor community to sustain their high valuation. To get a better idea of an asset's risk, investors look at its market cap along with its basic features, fundamentals, how it's set up in the market, and its general reputation. Assessing valuation, undervaluation, or overvaluation projects that exhibit strong fundamentals but have a relatively low market cap might be considered undervalued by the market. This could be due to the project being in an early stage of development, or perhaps due to insufficient marketing and exposure. On the other hand, if a crypto's market value seems too high for its actual technology or utility, it might be seen as overvalued. Gauging market viability and exposure. A project's market cap can also offer insights into its market viability and the extent of its exposure. A crypto's market cap often shows how big its network and community are. It can also give clues about how many people are using it and how much investors trust it. Comparing market cap versus other metrics. While market cap is a vital metric, it's often considered by investors alongside other indicators and fundamental analysis to get a comprehensive view of an asset's position in the market. Market cap versus fully diluted valuation, FDV. Fully diluted valuation, FDV, represents a cryptocurrency's market capitalization if its entire total supply, or sometimes max supply, if applicable, were in circulation. This excludes any coins that have been burned and removed from circulation. FDV equals total supply, or max supply times current price per token. Significance. FDV provides a longer-term valuation perspective, especially for projects with a significant portion of their tokens still locked or unreleased. If there's a big difference between a project's market cap and its FDV, it might mean more tokens will be released later. This could push the price down if not enough new buyers come in, reducing the value for current holders. Market cap versus cash inflow. Cash inflow in crypto refers to the amount of money flowing into the crypto market as a whole or into a specific asset. Meanwhile, market cap is the total value of all coins in circulation, reflecting how the market values an asset and fluctuates with price and circulating supply. While market cap can grow due to cash inflow when more people invest into an asset, this isn't the sole reason for its increase. As mentioned, the market cap can rise due to price appreciation alone, even without new money entering. Therefore, market cap is not always an accurate measure of net cash inflow. Market cap versus trading volume. The trading volume of an asset is the total value of all completed trade requests, buys and sells over a specific period. The 24-hour trading volume is a commonly used metric, indicating the total value traded in a single day. Trading volume is distinct from market cap, but also provides insights into market interest in an asset. Similar to market cap trends, an increasing trading volume can suggest growing interest, as more transactions naturally lead to higher volume for that time frame. A trading volume that is unusually high relative to its market cap that suggests a significant peak in interest, potentially preceding price movements. Conversely, low trading volume may indicate declining investor interest. Market cap dominance. This refers to the market cap of an individual cryptocurrency as a percentage of the entire crypto market's total capitalization. As briefly mentioned above, Bitcoin dominance BTC. D is the most prominent example, reflecting Bitcoin's share of the overall market. Changes in dominance can indicate shifts in market sentiment and capital rotation between Bitcoin and altcoins. How to use market cap to analyze cryptocurrencies. Investors commonly categorize cryptocurrencies based on their market cap, as assets within similar categories often share characteristics regarding market perception and risk levels. Small cap cryptocurrencies. Small cap cryptocurrencies are cryptocurrencies whose market cap is below $1 billion. They are regarded as developing assets and usually have less market exposure and a smaller investor community. While small cap cryptocurrencies are often perceived as having higher growth potential, they also come with a higher risk level due to increased price volatility and being listed on fewer exchanges. Examples include Floki, Radium Ray, Lido, and Pendle Finance. Mid-cap cryptocurrencies. Mid-cap cryptocurrencies generally have a market cap between $1 billion and $10 billion. They have a greater market presence, a lower risk profile, and potentially lower growth potential than small cap cryptocurrencies. However, when compared to large cap cryptocurrencies, they tend to have less market exposure and a relatively higher risk level. Examples include Toncoin Ton, Polkadot, Uniswap Uni, and Bitinsa DAO are some examples of mid-cap cryptocurrencies. Large cap cryptocurrencies. These are well-established projects with a market cap exceeding $10 billion. They are generally regarded as top-tier projects in the crypto space, possessing industry-wide popularity and a strong reputation. Assets in this category have built a broad and thriving market and boast a large, diverse investor community. Due to their established nature, they typically have a lower risk level and more modest growth potential compared to mid-cap and small-cap cryptocurrencies. Examples include Bitcoin BTC, Ethereum ETH, BNB Coin BNB, Solana Sol, and Dogecoin Doge. Investors constructing a cryptocurrency portfolio can use these categorizations to manage their risk exposure through diversification. A balanced portfolio might include a proportionate combination of small cap, mid cap, and large cap projects, tailored to an individual's risk tolerance and investment goals. Limitations of market cap. Knowing the market capitalization of a cryptocurrency is useful, but it doesn't tell the whole story. Here are some things to keep in mind. Project quality and fundamentals. A high market cap isn't a definitive indicator of a project's underlying technology, its utility, the strength of its team, or its actual adoption. Sometimes, excitement and hype can push a market cap up, even if the project doesn't have strong technology or a real use case. Liquidity. Market cap does not directly measure an asset's liquidity, i.e., how easily it can be bought or sold at stable prices. A project can have a high market cap, but still suffer from low liquidity, making it difficult to trade large amounts without significantly impacting the price. Token holder distribution. It doesn't reveal the distribution of tokens. A large portion of the supply might be held by a few entities, for example, founders, early investors, or the project treasury, which could pose a risk as they decide to sell large amounts. Potential for manipulation, especially for cryptocurrencies with lower market caps and thin trading volumes. Prices and thus market caps can be more susceptible to manipulation through pump and dump schemes or other coordinated activities. Snapshot in time. Market cap reflects the value at a specific moment and can be highly volatile, changing rapidly with price swings and shifts in circulating supply, not equal to invested capital. It's a common misconception that market cap represents the total amount of money invested into a project. It's a valuation based on the last trading price and circulating supply, not a sum of all investments. A crypto project's market cap shows how much the market thinks the project is worth right now. Market cap is more than just a number showing a project's total value. It also tells us about the project's progress, where it fits in the crypto world, and how the market sees its achievements and future possibilities. For investors, market cap can be an important metric, potentially offering clues about growth potential and relative risk. However, the utility of the market cap metric is significantly enhanced when used as part of a holistic analytical approach. This means looking at market cap together with other numbers like FDV, trading activity, and how its token supply works. It also means carefully studying the project's basics, like its team, tech, purpose, community, and how its tokens are managed. This comprehensive approach aids in determining whether a project might be overvalued, undervalued, or fairly priced relative to its peers and potential. Ultimately, always align your investments with your personal risk tolerance levels and conduct your own thorough research DYOR before making any investment decisions.